Welcome back to the Deep Dive. Today, we are putting on our deepest analytical spectacles, the ones we call the Buffett lens.
Yeah, right, because we are analyzing this business like we are actual owners, not just, traders checking a ticker every 5 minutes.
Exactly. And the company in our sights is Agilent Technologies, ticker symbol A.
Agilent is, it's currently trading around $148 a share with a market cap of, about $43 billion. And it's one of those really rare companies.
How so?
Well, it sells what is arguably the most valuable commodity in regulated commerce: certainty.
Scientific truth.
That's it. It sells scientific truth, and it has built this incredibly durable, high-margin business around that one simple necessity.
Absolutely. When we do these deep dives, we're on the hunt for these high-quality franchises, right? The ones that can compound capital for decades. And Agilent, it absolutely ticks that quality box.
It does, but there's a paradox here.
A big one. After going through all the sources, we found this champion company, a true blue-chip compounder, but the current market price, it just presents a serious challenge for a disciplined value investor.
So we're going to walk you through the 4 foundational questions to prove that quality. First, is the business simple enough to understand?
Then, does it have a deep, durable, competitive moat?
Is management rational? Do they think like us, like long-term owners?
And finally, the big one. Does the price offer any margin of safety?
And that last question, that's really where all the tension is.
It is. We've actually pinpointed the exact price where the stock goes from being just a great company to an undeniable investment bargain. We'll hold off on revealing that target price until the very end.
For now, it means we have to analyze this business with patience. We're looking for what I call the inevitable.
The inevitable. Explain that.
These are companies whose products are so embedded in these critical regulated workflows, think pharma, diagnostics, environmental safety, that you just can't easily displace them.
They're locked in.
Completely locked in. To understand that, we have to strip away the market noise and really dissect Agilent from its roots at Hewlett-Packard all the way to its complex but brilliant financial structure today. We're using fiscal year 2025 data and the latest guidance for 2026.
That history, that HP culture, it's everything here. We need to see how they pulled off that transition from just selling instruments to creating this high-margin service annuity that just feeds the balance sheet. So let's get started. Part 1, chapters 1 to 3. Business, Management, and Financials. Chapter 1, Business Understanding.
Okay, so to really grasp the quality of Agilent, we have to start not in a lab, but in a garage, where its DNA was forged. Hewlett-Packard.
But yeah, let's unpack that because it's not just a footnote. It's really the cultural foundation of the entire company.
It is. Agilent wasn't some flashy startup. This was the test and measurement division of HP, spun off in 1999. It was the original, serious engineering business that Bill Hewlett and Dave Packard built back in the 30s.
And that history matters.
It matters because Agilent inherited the HP way. It's a culture that's just defined by engineering precision, obsessive operational discipline, and a deep, deep commitment to quality.
When you're building instruments that have to measure things with parts per trillion accuracy, you need that mindset.
You do. It's the total opposite of the, move fast and break things mantra. This is more like German high engineering. Agilent builds laboratory assets, not disposable widgets. They're built to last.
That legacy defined them early on, but the company we see today was really born from a major strategic move they made in 2014.
Oh, absolutely key. In 2014, Agilent spun off its electronic measurement business. That's now Keysight Technologies.
Right.
And that let them focus exclusively on life sciences, diagnostics, and applied chemical markets. It was a huge move that defined their modern circle of competence.
So they shed the more cyclical electronics business to double down on biology and chemistry.
Exactly. And that focus is a major reason they can command such premium margins today.
And within that circle, their core product isn't even the machine itself. It's, as we said, it's scientific truth. Can you detail that? How are they the ultimate gatekeepers of quality?
Okay, think of it this way. Agilent provides the certainty that allows a multi-billion-dollar operation to move forward. Imagine a pharma company. They just made a huge, expensive batch of a drug like insulin.
Right.
Before they can ship it, their quality control lab has to prove, without a doubt, that the active ingredient is pure, it's at the right concentration, and it's free of any impurities.
And they can't just eyeball it. The data has to be good enough to stand up to regulators like the FDA or the EMA in Europe.
Unimpeachable data. That's the product. So they take a tiny sample and they run it through a workflow, usually starting with an Agilent liquid chromatograph or an LC.
The LC is the separation engine.
It is. It takes this complex mixture and it separates out all the individual components. Then those components flow into a mass spectrometer, or MS.
And the mass spec is the scientific gatekeeper.
It is the ultimate arbiter. The MS weighs the molecules with atomic precision. It tells you exactly what each component is, and just as important, how much of it is there. The data that prints out from the Agilent software, that is the irrefutable evidence.
And that piece of paper, generated by an Agilent instrument, dictates whether a multi-million-dollar batch of drugs gets shipped or scrapped.
Under immense pressure, yes. The machine provides documented, auditable, scientific certainty.
And here's where we, as investors, really focus. That necessity creates powerful demand inelasticity.
This is the critical insight. Labs can't just stop running these tests. Drug testing doesn't pause for a recession. Environmental monitoring doesn't stop because interest rates are high.
A slowdown might delay buying a brand new machine, sure.
Right, it might delay that for 6 months. But the thousands of instruments already installed, the ones running 2047, they have to be continuously maintained and fed with consumables. This creates a baseline of recurring demand that is just incredibly valuable and predictable.
And that recurring demand brings us to the most powerful part of their business model, the economic moat, built on that classic razor and blade ecosystem.
Executed with surgical precision, the razor is the instrument itself. These are the big, upfront capital expenditures.
The CapEx.
The CapEx. We're talking about the LCs, the gas chromatographs, the mass specs. These mostly fall under their life sciences and diagnostics group, or LDG. In fiscal year 2025, that segment brought in about $2.7 billion. It's the expensive ticket that anchors the customer.
But the real money, the predictable high-margin wealth, that's the blade. The Agilent Cross-Lab Group, or ACG.
That is the resilience engine. Once that razor is installed, and these things can last for decades, that lab is now a continuous consumer of high-margin blades.
Things like columns, chemical standards.
Replacement parts, certified maintenance contracts, software licenses, you name it. For FY 2025, ACG generated $2.9 billion. It actually surpassed the instrument revenue.
And that accounts for what, 42% of total sales?
42%. But it's not just the size, it's the margin profile that makes this business truly elite.
Okay, let's talk about that margin magic.
The ACG segment boasts an operating margin of 32.5%.
32.5.
32.5%. When you realize the overall corporate margin is much lower, you see where the real profit power is, and that margin comes directly from operational necessity.
Right, so let's make that real for you. If a lab spent $500,000 on an Agilent machine and it breaks down on a Tuesday afternoon, stopping a critical manufacturing line,
they're losing thousands of dollars an hour. So are they going to spend 3 weeks getting quotes from third-party repair shops to save 5% on a part?
no way.
No. They're going to call Agilent and pay whatever the premium rate is to get a certified expert on site within 24 hours with certified parts. Speed and compliance completely trump price sensitivity. That urgency is the root of that 32.5% margin.
And that urgency leads us to the second, deeper layer of the moat, what we're calling the bureaucratic moat. It's driven by these astronomically high switching costs.
This is such a profound competitive advantage. It's something you just don't see if you only look at the balance sheet. It's not just that it's technically hard to swap a machine.
It's the regulatory nightmare.
It's the regulatory labyrinth, exactly.
So let's detail that. If a pharma company gets FDA approval for a drug, and the approval is based on data from, say, a specific Agilent 1290 Infinity 2 LC system,
Right.
that specific instrument and the method they used, it's all written into the standard operating procedures filed with the FDA.
Correct. That method is locked in. So if 6 years later, that company wants to save a little money by switching to a competitor's machine.
They can't just plug and play.
Not at all. They have to undertake a massive time-consuming process called revalidation.
Which means they have to prove to the FDA, with tons of testing and paperwork, that the new machine gives statistically identical results to the old one.
The cost is staggering. You're talking about dedicating highly paid scientists to months of comparative testing and documentation. The total cost of this revalidation, it often runs into the hundreds of thousands, maybe even millions of dollars.
For one manufacturing line.
For one line.
Yeah.
So whatever you thought you were saving by buying a cheaper machine, it's completely dwarfed by the administrative and regulatory cost of switching. It creates such a strong disincentive to change.
It's a guaranteed incumbent advantage.
It effectively ensures that once an Agilent platform is in a regulated lab, it becomes a permanent anchor, guaranteeing decades of that high-margin cross-lab service revenue. It makes the moat incredibly durable.
Okay, that makes it clear why the business is simple and the moat is durable. So let's look under the hood at the three segments, the engine room, to see where the growth is actually coming from.
The first engine is the Life Sciences and Diagnostics Markets Group, or LDG. This is the innovation spearhead. It sells those high-cost platforms, the instruments, pathology tools, genomics.
And LDG had a really strong rebound in the fourth quarter of 2025, didn't it?
Very strong. It reported $755 million in Q4 revenue, which was 15% reported growth year over year. And that's a massive positive signal.
Why?
Because it suggests the instrument CapEx cycle, which had been really depressed, is finally moving into recovery, and it's being heavily driven by the biopharma wave. These complex, large molecules, biologics, they need much more sophisticated mass spec tools for analysis, which fuels demand for Agilent's latest tech.
Okay, so engine 1 is firing. What about engine 2, the Agilent CrossLab Group, ACG, a resilience engine?
ACG is the stability provider. It actually matched the instrument business in size for the quarter, also hitting $755 million with a steady 7% reported growth.
And we already know about its elite 32.5% margin.
Right. So its strategic role is to dampen the cyclicality. When LDG growth slows down, ACG keeps the revenue and profitability stable. It's the corporate shock absorber.
And finally, the Applied Markets Group, AMG, the utility player.
AMG is the smallest, at $351 million in Q4, growing at a respectable 4%. Its function is strategic diversification away from that primary focus on biopharma.
So this is environmental testing, food safety.
Forensics, yeah. And there's a major global tailwind driving this segment right now.
Yeah.
The mandate to test drinking water for PFAS, so-called forever chemicals.
Ah, all right.
Regulations are tightening on these compounds all over the world, and Agilent has the leading established testing workflows for PFAS detection. So when regulations tighten, this segment gets a direct structural benefit.
Okay, so to sum up Chapter 1, we have the HP legacy of precision, the necessity of scientific truth, that powerful cross-lab annuity, and a bureaucratic moat that makes switching vendors just prohibitively expensive.
Structurally, it is an exceptional business. It passes the first two tests. Simple and durable moat.
Chapter 2, management evaluation.
So the third test is management, the jockey. We need to know if the people running this operation are rational capital allocators who think like owners. And in May 2024, Agilent appointed Padraig McDonnell as their new CEO.
This transition is really important because of his background. He's an insider who ran the high-margin annuity business.
Exactly. McDonnell previously ran the ACG segment, so the board choosing him sends a very strong signal. It says that management is prioritizing that profitable blade business model over just chasing volume and instrument sales.
For long-term investors, that's a compelling direction.
It is, and he immediately launched what they call the Ignite strategy.
We need to know, is this just corporate jargon, or is there some real substance here?
Well, Ignite is their attempt to impose operational velocity and fight that corporate bloat, kind of like what you see at a company like Danaher. The key is simplifying their structure to increase customer intimacy.
How are they doing that?
Instead of organizing by product line, LC, MS, GC, they're restructuring to align with end markets. So you'll have a pharma workflow solutions unit or an applied chemical solutions unit.
So the goal is to make it easier for a big client to just buy a whole end-to-end workflow solution from a single unified team.
Correct. It streamlines the customer experience, it improves internal efficiency, and most importantly for us, it aims to boost margins. And we're seeing early results. Management actually cited the Ignite strategy as a direct cause for the sequential 210 basis point expansion of operating margins in Q4 2025.
That's a direct lift to the bottom line from efficiency.
That is the purest form of shareholder value creation.
But let me inject a point of tension here. If the CEO came up through the margin-obsessed cross-lab segment, how do we make sure he doesn't inadvertently starve the R&D budget? The future of the razor depends on innovation, which lives in the LTG segment.
That is the essential tension you have to monitor. The short-term incentive is always to protect that 32.5% ACG margin, but the long-term health of the company demands continuous investment in new instruments.
So if R&D budgets start to lag competitors,
The moat will eventually erode. And we did note that R&D was down slightly in fiscal year 2025. It's a yellow flag. It could be temporary, but if his focus on operational velocity leads to continued underinvestment in innovation, that alignment suddenly breaks down. For now, we rate them as rational, but with that specific caveat.
okay, let's look at compensation. We want management's wallet tied to our long-term results.
The alignment here is excellent. CEO McDonald's 2024 compensation was about $9 million, but crucially, a massive 92% of that is designated as at risk.
Meaning it's tied directly to stock performance and financial targets.
Exactly. Revenue growth, margin goals.
Mhm.
So he benefits tremendously if the company hits its marks, and he suffers a significant financial consequence if it doesn't.
That's strong alignment. But we did see that minor yellow flag on insider transactions.
That's right. We saw some recent insider selling. McDonald's sold about $250,000 worth of stock in September 2025, and other executives sold as well.
Now, a lot of the time, these are just pre-scheduled 10b5-1 plans for diversification or taxes.
They often are, and they can be mundane. But as disciplined investors, we always prefer to see insiders actively buying stock, not selling it. It signals deep conviction. Selling near all-time highs, even if it's scheduled, is just. It's never the signal you want to see. It's a neutral to slightly negative data point.
Chapter 3. Financial health.
All right, let's move to the scoreboard. The financial results for FY 2025 are the mathematical proof of the franchise's health. And we start with the top line.
FY 2025 full-year revenue came in at $6.95 billion. That's 6.7% reported growth. But the real story is the momentum we saw in Q4.
The fourth quarter was the inflection point. Q4 revenue hit $1.86 billion, accelerating to 9.4% reported growth. And that acceleration is so crucial because it signals that the painful 18-month-long destocking phenomenon is finally over.
Let's pause and define that because it's key to the turnaround story. What is destocking?
So, during a supply chain crisis in 21 and 22, customers panicked about lead times and shortages, so they overordered everything. Instruments, consumables, you name it.
They stockpiled.
They aggressively stockpiled the blades. Then, once the supply chain normalized in 2023, they spent months just working through all that excess inventory, which caused a painful dip in new orders for Agilent.
And the strong Q4 growth suggests the cupboards are now bare.
Exactly. Customers are back to investing in new capacity and steady-state consumption.
That's the good news.
Yeah.
But if you look beneath the surface of that growth, there's a geographical divergence that reveals a major risk.
It couldn't be starker. In Q4, revenue in the Americas and Europe grew a robust 11%, powered by strong biopharma demand.
But that strong performance was masking weakness elsewhere.
It was masking complete stagnation in the Asia-Pacific region, which reported 0% growth. And that is almost entirely due to the economic slowdown in China, which accounts for about 20% of Agilent's total revenue. The health of the Chinese market is a significant weight on the entire business.
Okay, let's move to profitability. This is where you really see that HP DNA in the numbers. The gross margins are impressive.
Agilent's gross margins are hovering around 54%. For a company that makes complex hardware, that is extremely high. It speaks directly to their brand's premium pricing power. Customers know an Agilent instrument is reliable, and they're willing to pay for that, especially when regulatory compliance is at stake.
And the operating margin confirms that efficiency.
Q4 operating margins hit 27.2%. The S&P 500 average is, 15 to 17%?
Right.
Agilent is operating at nearly double the efficiency of the average major U.S. company. And that, of course, is heavily driven by the CrossLab Group's staggering 32.5% margin.
Okay, so now let's talk free cash flow. The owner's earnings. For the 12 months ending in October 2025, FCF was $1.15 billion. A huge number, but this is the primary financial yellow flag we found.
It is. FCF is down 16% from the prior year, even though net income and revenue are both rising.
And that kind of divergence is a warning sign. When profit goes up but cash flow goes down, it means the quality of the earnings is, at least temporarily, poor.
Right. Net income is an accounting profit. Free cash flow is actual spendable cash.
So where's the cash going if the accounting profit is rising?
The main culprit is likely changes in working capital. As they come out of that destocking phase, management has to rebuild inventory to meet new orders. Or maybe their accounts receivable have gone up as sales accelerate.
So it could be a temporary issue related to growth?
It could be. And if it's just inventory building to meet future demand, that's actually a positive signal. But for a blue chip company, you want to see FCF track closely with net income over time. This 16% divergence is something we have to see converge back in fiscal year 2026. If it continues to lag, it could suggest a more structural problem.
But despite that cash flow timing issue, the balance sheet is undeniably pristine.
It is a fortress. Agilent finished FY 2025 with $1.46 billion cash versus about $3 billion in long-term debt, so their net debt is trivial compared to their earnings power. With EBITDA approaching $2 billion, the net debt to EBITDA ratio is comfortably below 1.
Below 1.0. That's incredible flexibility.
It is. It means they could pursue a large acquisition, or, more importantly, they can weather any severe economic crisis without stressing the equity or needing expensive financing.
We can really visualize this quality using the DuPont analysis.
The DuPont analysis is invaluable because it breaks down return on equity into its three drivers: profitability, efficiency, and leverage. Agilent achieved an elite ROE of 23.6% in FY 2025.
And how did they get there?
Through superior profitability and minimal financial risk. Their net profit margin was exceptional at nearly 23%. But the key is the third component. Their financial leverage is remarkably conservative at just 1.89.
So they're generating these elite returns without using a lot of debt to juice the numbers.
Exactly. The returns are coming purely from the quality and profitability of the underlying business, not financial engineering. It's the hallmark of a true, high-quality compounder.
Like and subscribe to Stock Analytics AI.
Apologies to all members. We have been demonetized by YouTube for repetitive content. They clearly don't understand what we are doing here. The good news is that we are going to continue. For members, sign up at stockanalytics.ai, and within the next few weeks, we will upload access to the full 600 videos for the S&P 500 and NASDAQ 100, and the coming 500 top AI stocks of 2025, $5 per month, and we will begin adding more features to the web application by the week, so joining early will be a great advantage.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
Okay, Agilent operates in an oligopoly. There's just a handful of huge players that dominate this market. So to properly value Agilent, we have to benchmark it against its three main rivals: Thermo Fisher, Waters Corporation, and Danaher.
Let's start with Thermo Fisher, TMO, the giant in the room.
TMO is the industry behemoth. People call it the Amazon of life sciences. Over $42 billion in revenue. Their advantage is just overwhelming scale and logistics. They sell literally everything a lab could possibly need.
So if TMO is the Amazon, what's Agilent's counterpunch?
Agilent is the specialist. They focus intensely on that cohesive analytical workflow, especially chromatography and mass spectrometry. They're often seen as having better integration and software for analytical chemists in regulated testing.
And that focus lets them win big contracts, even against TMO's scale.
It does, and you see the difference in valuation. TMO typically trades at a hefty premium, around 35 times forward PE, versus Agilent's current 32.
Okay, next up is Waters Corporation, Watt. Maybe their most direct competitor technologically.
Waters is the niche champion. They specialize almost exclusively in high-end liquid chromatography and some mass spec applications. Their reputation is built on extreme precision.
But Agilent's strength is its breadth and that service integration.
Precisely. Waters is very exposed if the LC-MS capital cycle slows down. Agilent, on the other hand, is the clear market leader in gas chromatography, and they have a much wider portfolio. That diversification makes them more resilient.
Plus, that cross-lab service network, generating 42% of sales, is much bigger than what Waters has.
It gives Agilent superior resilience, for sure.
And finally, we have to look at Danaher, DHR, the operational gold standard.
Danaher is the masterclass in capital allocation and operational excellence. They famously use the Danaher Business System, or DBS, to ruthlessly optimize efficiency in every company they acquire.
And their valuation reflects that perfection. Danaher trades at an astronomical premium, around 48 times PE.
That massive valuation gap is the key takeaway here. Agilent trades at a steep discount to Danaher.
So if Agilent's new Ignite strategy is really their version of the Danaher Business System,
and if they can use it to drive margin expansion, then there's massive room for the multiple to expand. The market is saying Danaher is perfect. If Agilent can get closer to that perceived perfection, the re-rating could be huge.
So Agilent is kind of in a Goldilocks zone, more agile than Thermo, more diversified than Waters, and with a clear catalyst to close the valuation gap with Danaher. Chapter 5. Ownership Structure.
Okay, so we've confirmed the business is high quality. Now we need to look at how they deploy that $1.15 billion in annual free cash flow, the capital allocation strategy.
Let's start with the cornerstone, R&D, the lifeblood of the moat.
Agilent invested $455 million in R&D in FY 2025. That's about 6.5% of revenue, which is robust. But we have to reiterate the point from Chapter 2.
It was slightly down from the prior year.
It was down from $479 million. That slight decrease needs to be monitored. Innovation is the only long-term defense against commoditization. We need to see that R&D investment growing, not shrinking.
Okay, what about the dividend?
They're a consistent payer, but the yield is modest, less than 1%. The dividend is safe and growing, but it's not a major part of the investment thesis.
Which brings us to the most debated part of their capital allocation, share buybacks.
Agilent has been aggressive here, repurchasing $1.15 billion in stock in FY 2024.
But let me challenge that. Buying back stock is only really value accretive when the stock is cheap. Agilent was doing these buybacks at PE, multiples of 25 to 30 times. That is hardly a bargain.
And this is the core tension for a value investor. On one hand, buybacks reduce the share count, which boosts EPS. Management is often incentivized to do that.
On the other hand, $1 billion is a lot of capital. Buying back stock at 30 times PE, management is essentially saying that's the best possible use of cash. Better than a special dividend or saving it for an acquisition.
When your FCF yield is only 2.66%, buying back shares that aggressively requires extreme conviction in future growth. There's no margin for error.
Finally, let's talk acquisitions. Their strategy is focused on tuck-in M&A, and the purchase of BioVectra is a great example.
BioVectra is a CDMO, a contract development and manufacturing organization. This is a fascinating move because it moves Agilent up the value chain.
So instead of just providing the tools to test a drug,
they're now directly involved in helping manufacture the drug.
That expands their addressable market, but does it introduce margin risk?
It absolutely does. Biopharma manufacturing typically operates at lower margins than that pure play 32.5% margin cross-lab business. Integrating a CDMO will require strong operational discipline to make sure it doesn't drag down overall profitability. It's a calculated bet on long-term growth.
Chapter 6. Risk Assessment.
Okay, we have to apply the inversion principle, as Charlie Munger taught us. How could we lose money here? What are the biggest threats?
Risk number 1 is the most visible right now. The China drag and geopolitics.
China is 20% of Agilent's revenue, and the flat growth we saw is a massive headwind. The threat is multifaceted. First, there's the structural slowdown in China's economy. Second, and more insidious, is the risk of domestic substitution.
The Buy China mandates.
Exactly. The government could require state-funded labs to buy from local rivals, locking Agilent out. Plus, U.S. export controls could restrict their ability to sell their most high-end instruments to Chinese customers.
And the supply chain is under pressure from tariffs.
Right. Management has created a tariff task force, and they claim they can fully mitigate these risks by shifting supply chains. But that effort adds complexity and cost that their domestic Asian competitors just don't face.
Okay, risk number 2. The cyclicality of capital expenditure.
A $400,000 mass spectrometer is a discretionary purchase in the short term, and a huge portion of Agilent's customer base is small to mid-sized biotech companies funded by venture capital.
And when rates are high, that VC funding dries up. We call it the biotech winter.
And in a biotech winter, those small companies stop all expansion. They stop buying new instruments. They just sweat their existing assets. While we're seeing a recovery now, any prolonged period of high rates could instantly stall that instrument recovery and hit the LDG segment hard.
And finally, risk number 3, commoditization.
The moat is durable, but it's not impenetrable. Competitors, especially from Asia like Shimadzu, are offering increasingly capable instruments at lower prices. The price-to-performance ratio is steadily improving.
So Agilent risks becoming the expensive legacy option.
That's the threat. To maintain the moat, they have to continuously innovate, especially in software and data analytics. And that is why that slight R&D decrease we noted is a trend that absolutely must be reversed.
So, given all these headwinds, what's the outlook for fiscal year 2026?
Management has given cautious, prudent guidance. They're forecasting revenue between 7.3 and 7.4 billion, which implies 5 to 7% core growth.
And EPS guidance.
Between $5.86 and $6, the narrative is explicitly relying on continued strength in the Americas and Europe, plus the stability of that high-margin ACG business.
So, in short, they are not banking on a miracle turnaround in China.
Exactly.
Yeah.
They are managing expectations by focusing on operational efficiency and stability, which sets a manageable bar for investors to judge them by.
Chapter 7. Conclusion.
So we've established that Agilent Technologies is an exceptional business. It's simple, has a fortress balance sheet, a durable moat, and well-aligned management.
We checked off 3 of the 4 boxes with flying colors, but now we get to the most crucial question for a value investor. Does the price offer a margin of safety?
And at the current share price of $148.52, the answer is a definite, resounding NO.
Let's break down the valuation to justify that.
Hmm.
If we take the midpoint of their FY 2026 EPS guidance, about $5.93, Agilent is trading at a forward PE of roughly 25 times.
25 times is the price of quality. This company deserves a premium, but 25 is not the price of a bargain.
Now, relatively, it's cheaper than its peers. TMO at 35 times, Danaher at 48.
And that's the bull case. If the Ignite strategy works and the market re-rates Agilent to TMO's multiple, you could see 40% upside to a $207 price target. But that's speculative.
As disciplined investors, we focus on absolute value, which means the free cash flow yield.
With 1.15 billion in FCF on a 43 billion market cap, the FCF yield is only 2.66%.
Let's put that in context. You can go buy a risk-free U.S. Treasury bond today and get, what, 5%?
Exactly. Why would you accept a 2.66% yield from a cyclical stock that comes with significant China risk, R&D concerns, and CapEx cyclicality? You wouldn't.
So the market is pricing in flawless execution and massive growth for years to come. There is zero cushion.
So the conclusion of this deep dive is firm. Agilent is a blue-chip compounder that belongs on every quality investor's watch list. But at 148, there is no margin of safety. It is a half part.
We have to wait patiently for the market to price in some of those risks. So, what is our target entry price? Where does this stock become a bargain?
We believe a correction that brings the stock price into the $120 to $125 range would compress that forward PE multiple down to about 20 times.
A 20x multiple.
At 20 times, you finally get the necessary margin of safety. A cushion that lets you absorb some unexpected turbulence from China or another biotech winter and still achieve acceptable long-term returns. That is the price where you can invest with deep conviction.
So here's the provocative thought to take away from this, and it's straight from Benjamin Graham and Warren Buffett. In the short run, the market is a voting machine, but in the long run, it is a weighing machine.
Agilent Technologies weighs a lot. It is a heavy, profitable, high-quality business. But right now, the voting machine of market sentiment has just set the price a bit too high for us to commit capital today. We have to wait for the weight of value to pull the price down to our entry point.
Like and subscribe to Stock Analytics AI.
And a quick reminder that this deep dive is based purely on AI-powered research and analysis of the public sources provided. It's intended solely for educational purposes. We are conveying information contained within the source material and are not endorsing any specific financial actions.
You must always conduct your own research before making any investment decisions. We'll catch you on the next deep dive.